Good afternoon, everybody. I'm hoping you can hear me. For those who don't know, my name's Luke Laretive. Welcome to the inaugural Seneca Financial Solutions quarterly webinar. Here with my colleague and friend, investment analyst for Seneca, Ben Richards. Our plan is today just to run through the quarterly numbers for all of our investment products and give you guys some insight into the investment process. Our sort of plan longer term with these is to run them every quarter, about 4 weeks after the end of the quarter. And really, like I said, just give you guys some more access to us. Hoping today we can keep it to sort of 20, 30 minutes. And then that gives us plenty of time for Q&A if people want to participate in that. Try and keep it fairly, sort of as usual with me, fairly informal and relaxed. If you have any questions throughout, you can use the Q&A function in Microsoft Teams. I'm hoping this is all working like it's the first time, so if it's a little bit tricky, please bear with us. But we might sort of get the ball rolling and get this show on the road in just a minute. I'll sort of just wait. We had about 75 people register for this, which sort of blew my mind a little bit. But we've got 34 in the webinar at the moment, so I'll just give everyone maybe 1 or 2 minutes. I'm not going to hang around too long, but just give everyone a chance to come through. There's still a few people popping in now. So yeah, like I said, hopefully 20 or 30 minutes.
And if you've got a question, we'll stop at some point and at the end. Yeah, so.
we'll stop halfway and do if there's any Q&A, and then about sort of the stock specific stuff, and then when we get into the multi-manager stuff, we'll finish that and then get to the end. And if there's any more, we can keep coming. Thanks to those people who have submitted questions prior. We're going to get to those, and they're at the end of the presentation too. So don't stress on that front. Cool. All right. It's 2 minutes past, and I like being on time. So like I said, for those who just joined, this is the inaugural Seneca quarterly webinar. Let's rock and roll.
So for those of us who aren't familiar with the Seneca business, we manage 7 discrete portfolios. There's two funds that invest directly in shares, the Seneca Australian Shares SMA and the Seneca Australian Small Companies Fund. The Australian Shares SMA invests in 20 to 40 companies from inside the ASX 200, while the Small Companies Fund, which is only open to wholesale clients at the moment, can invest in up to 50 companies from anywhere on the ASX, but with a distinct bias to emerging growth companies. And down the bottom of the slide there, so those are the multi-manager SMA products. They invest in the asset classes where we want clients to have exposure, but are not best placed to select the underlying individual investments ourselves. In these portfolios, the investment committee selects between 4 to 8 managers in each portfolio from our universe of many, maybe thousands, each month when the investment committee meets. And the investment committee actively manages these portfolios too. So we can tilt the portfolios to where our analysis indicates that relative value exists, but within the governance constraints of each individual mandate.
And I suppose this is a quick intro for those who maybe aren't as familiar with our business into the investment committee. It's John, my business partner, and myself with 2 independents, Gavin Duckett and Ben Griffith, who chairs our committee at the moment. As I said, they've got some really good experience, diverse set of experience, and we'll continue to sort of keep that committee quite fresh, I suppose, with new thinking and new ideas kind of rolling through there on a reasonably regular basis. But we're there to make the decisions and run the governance of all of this entire framework that we're going to walk through today. So let's get started with our first SMA that we launched, and the one that's been around the longest, which is the Seneca Australian Shares SMA. As Ben said, 20 to 40 companies from inside the ASX 200 with a distinct focus on sort of quality and growth businesses at reasonable prices. That product marginally underperformed, 10 basis points or something, so not too stressed about that during Q1. Mainly dragged down by our lithium positions and a little bit of iron ore exposure, which wasn't so good during the quarter. We had some really good results though, and a lot of the alpha, or a lot of the performance we did generate during the quarter was from sort of earnings and kind of really good quality, I suppose, what I could call good quality returns. Goodman Group, ResMed, PEXA, Webjet all had various either first half, quarterly or strategy day type updates and did really well and put some really good numbers together. Detractors, as I said, Lithium, Sonic Healthcare was probably the one sort of bad stock pick for the month, I suppose, or for the quarter, I'm sorry, which, yeah, the results were pretty weak. They're sort of seeing some wage cost inflation and not really being able to sort of pass that on with higher prices and manage that as a business. We've exited that now. And Collins Foods sort of dragged down on its sort of correlation to Domino's, despite, in our view, those businesses diverging in quality over the last few years. We've actually added to our Collins Foods position and we think that's going to report well this month. So the changes for the month were sort of, we added to Webjet, Monadelphous new position, Woolies new position, added to Collins Foods, New Hope Group is back, added to our Pilbara and Arcadium Lithium, as we've got, really strong high conviction views on lithium long term. Coming out with Sonic Healthcare, like I mentioned, we also cut our exposure to Macquarie, ANZ and Westpac. We think the banks are really expensive at the moment, trading at sort of 1+ standard deviation above average valuations. And yeah, we think that's been a good funding source to go and chase some of these other sort of industrial growth businesses inside the 200. We're trying to do a stock in focus or a couple of stocks in focus, a couple of positions in focus to give you some transparency on what we're doing. And Webjet is something that we're really excited about. If you follow some of the other media that we do, we've talked about that a few times, both Ben and myself. Webjet is a travel business, and most people probably think about it as a place where an online travel agent, essentially, where you would book flights. This is a sort of a bit of a furphy now, because Webjet's business, as you can see from the pink chart there that we put up for you, their business has become a much more of a B2B business now with the WebBeds business, which we're attracted to. It's capital light, it's high margin, it's super scalable. And Webjet's got $400 million in net cash there to drive returns for shareholders from that. Stock's trading on only 13 times EV to EBITDA at the moment. But we think that's sort of an average valuation for Webjet, but their business is, much better quality and growing much faster than it ever has before. The likes of Airbnb or Booking.com trade on sort of 16 and 23 times respectively. So we think there's scope for a significant re-rate in Webjet, and we're really excited about it. It's one of our biggest positions at the moment, and certainly one of our largest active weights. Might hand over to Benny for a bit of a small companies fund rundown.
Yeah, so the Australian Small Companies Fund, it is a new fund offering. We launched it in October last year, so it's just clocked up 6 months since inception.
7 months now.
7 after April, which we look forward to reporting the April numbers. Had a good April. This is a wholesale only fund, so just bear that in mind. And it's managed by Luke and myself. We both got experience in Australian small caps, and I suppose primarily we kind of launched the product late last year to capitalise on the opportunity that small caps presented. There's been a bit of a dislocation between large caps and small caps that emerged in 2022-23 since the start of the interest rate hiking cycle. Also worth just pointing out that this is a zero management fee fund. We only charge performance fees for positive returns over and above the RBA cash rate with a high watermark. And this really aligns us with investors. We only make money when you make money. And this fee structure, it's subject to change if we grow the funds under management. We've talked about what we might do there, but if we say hit 10 million in funds under management, we might, for new investors, change the fee structure. So obviously that'll be the same for existing investors now, but just bear that in mind if you're considering an application. So just talking about a bit about the performance, bearing in mind it is only 6 months since inception on these numbers. We've generated a 9.37% net return, and that's a bit behind the Small Ordinaries benchmark. You can see it does fluctuate month to month there. We started off ahead and then gave up a bit in November, December, just due to our kind of lower weights relative to the index in things like REITs and gold miners. but we remain confident that the positioning is setting us up for longer term outperformance.
Had a big April.
Big April. We've clawed back a lot of that relative performance since the end of March.
We're going to be positive April, and the index is down like 3%. So I think it's going to be a 4 or 5% swing our way.
Yep. And just in terms of what's been driving those returns, we do obviously write up some commentary in the monthly report, so keep an eye on them if you're wanting to stay up to date. GQG Partners is a global fund manager. I'll talk about that in a bit more detail in a second on the next slide. Index and MMA Offshore might be a bit less familiar to clients. MMA Offshore, it's an offshore vessel provider to the oil and gas industry. It's got 20 vessels. It's been a long down cycle since 2014-15, and these assets were trading at a fraction of what the replacement cost, especially in an inflationary environment. So yeah, I mean, shares did really well for us, and they actually recently received a takeover, $2.60 per share, and our average entry price was about $1.30. So it represents almost 100% gain since we bought it. Index, it's the leading provider of tools and technology for the exploration drilling sector. It's really strongly supported by gold and copper activity, and as the commodity prices there have kind of trended up over the last few months, we think demand for Index tools and services should be robust, and think there's still good upside there. In terms of detractors, lithium, we've kind of touched on already, and it's well documented in kind of the media stuff that we do. DGL Group is one that had a poor result. It has some exposure to agricultural chemicals, which are obviously cyclical, and kind of disappointed the market there. And you can see there in the changes that we actually exited that position during the quarter, alongside Credit Corp, which we also exited after it kind of rallied strongly from its lows in October last year. And also during the quarter, we added to RPM Global and Australian Finance Group, AFG. We've met with both companies' management during the quarter, which is a key part of our process in the Small Companies Fund, and it just gave us more conviction in the earnings trajectory of both of those companies. So we'll just dig into a couple of holdings here. GQG Partners, again, it's one we've talked a bit about. It's a global fund manager, offers scalable strategies, and it's a pretty simple thesis, really. It's been enjoying really strong performance, which is generating strong inflows, and yeah, funds under management's growing really strongly, which on the current valuation and dividend yield continues to be really attractive. I'll just jump over to the next one. RPM Global, talked a bit about that as one we've added to this quarter. It offers a suite of software products that service the global mining industry, and kind of the key takeaway from this slide is, if you look at that chart there, they've been transitioning from licenses to subscription revenue, and it's really masked the strong underlying growth in that business. They service all the big mining customers in kind of end-to-end mine planning, simulation, finance, equipment management, all that kind of stuff. So BHP, Rio, Glencore, they're all customers of RPM Global. And yeah, it's a really strong growth business that's pretty under the radar compared to other software businesses in the large cap universe particularly. And it trades on a valuation which we think is attractive, and given management's track record, we think that's a likely takeover target in the next sort of 12-24 months.
All right, I might open the floor up. Has anyone got any questions on stock specifics, either in the large or the small cap? For speak now or forever hold your peace until the end of the presentation. All right, I'm going to take that as I haven't seen anything in the Q&A here. Let's have a quick look. No, donuts. So just going to keep moving on. If anything does change, let me know. So we're going to push to the multi-manager portfolios now, but I just kind of wanted to explain, maybe for those who are new, why we run SMAs or separately managed accounts here at Seneca relative to running, a suite of managed funds or ETFs or listed investment company or any of the other structures that are available. We really like the direct ownership that having an SMA can offer people. Unlike a managed fund or a listed investment company or an ETF, each individual share or individual managed fund that we own is owned directly by you as an investor. You get full transparency on the portfolio. It's pretty similar to what you would see on a normal HIN-based sort of stockbroking account. It means that whether you want dividends reinvested, whether they want that paid out to you, you actually see all that cash come through as it hits not at distribution time, and it's not sort of aggregated by us in any way. Your money's never pooled. You get full transparent tax reporting, benchmarked, everything you need. But every day you can go on and check your franking credit balance or your CGT position. And it also allows us to ensure that all clients are always invested equally, and at the same time across the board. Doesn't matter whether it's a 100 mil client or a 100 grand client. Every client's perfectly invested in line with our views, in the best products we've got access to at all times at the same price. And it just means we get sort of ultimate equality across our entire client base and can service clients up and down the value chain. I think it's important also, just because we do run models, we do have flexibility. We can exclude things. We can set up rules for each individual client. So whether that's, filtering for ethical preferences or maybe if you're an ASX listed company director and you can't be holding stock in a particular company or can't be buying and selling shares in a particular company, we can manage all of those. And we do manage those for a number of clients already. So I think, it's a really, really nice way to run money. It's a very high growth part of the sort of wealth management industry, for lack of a better word. And we're really proud of the suite of sort of 6 SMAs we run. And we think they're probably continuing to grow quite well. So the Australian Equity SMA, not to be confused with the Australian Shares SMA, and I know that is a bit confusing. This product owns 25% invest 25% in our Aussie shares portfolio, but we're not the only good Australian equities manager out there. And certainly with the style of management that we do here is not the only way that works. So the other 75% is invested with up to 4 to 8 managers in total, including us. It's actually been performing really well. The allocation to smalls and property managers has seen some good outperformance recently, and we made a small change to one of the small cap managers during the quarter. That's been continuing to perform well for people who do look for a sort of more diversified approach to Australian equities, rather than just the direct shares that I and Ben and I choose. We've also got the global equity portfolio, and that invests again in 4 to 8 managers from around the world. We like to cover off, some emerging markets, some developed markets, some's hedged, some's unhedged, some small cap exposure, some large cap exposure, get across the sectors as well. So we're overweight emerging markets, and that's been a bit of a drag on returns so far. But I mean, China had a ripping week last week, and it's had a pretty good month as well. Best performing region in the world. So we think this pain's sort of starting to go away, and might be time where this overweight in emerging markets starts to pay off. We've had some really good contributions from what has been, objectively exceptional manager selection. GQG Global, GQG Emerging have both been kind of top of peer group in those, and Fairlight's been one of, if not the best, small cap, mid cap global fund manager in our universe. So been really pleased with those selections. Platinum Europe, we had a bit of a tactical kind of European equities tilt for a while on a valuation basis, and we've taken that out now, but we still made really good money there, and that was a good tilt for us. Added some more emerging companies exposure. We think smalls are undervalued, reduced the European exposure, and that's really been the one change for the quarter. Just wanted to highlight, I suppose, Fairlight. Nick from Fairlight's I consider him a friend, and we started our businesses at the same time, and they really do similar to what Ben and I do here, just in a different universe, being sort of global small and mid cap companies. really focus on high quality growth, stable compounders, the odd one or two, turnaround value type ideas. But really, historically, their returns have been generated through those first sort of two styles of investing, which is pretty similar to the kind of thing we try and do here. Some of the companies that, for clients, we've invested in directly over the years, which, we're doing a little bit less of these days with these kind of products available. But you can see there on the sort of returns on the y-axis and volatility on the x-axis, you want to kind of be as high up and over to the left as possible. And you can see Fairlight's been generating, fantastic returns relative to their peer group. And I don't see any reason why we'd be taking that out of the portfolio at any time in the near future. They're doing a fabulous job for us and really good at what they do, and got a really sustainable process and approach in our opinion. Just transitioning, I suppose, to the income side of the ledger, we run two income portfolios. This is the first, the Seneca Aggressive Income strategy. This is probably the most unique strategy that we've got in our suite of SMAs. It can invest in up to 30% income-focused equities, so think like property and infrastructure or high dividend particular strategies. And then the balance, we don't have to have that 30%, but the balance is in fixed income. It can be investment grade or sub-investment grade strategies. At the moment, we've got a lot of exposure to private credit, as you can see, KKR, metrics, as well as some Australian property stuff unlisted. So it's been doing very well. It's got a really high dividend yield. It's 9-point-something% distribution yield on that particular product. It does take more credit risk than the defensive income portfolio, which we're about to talk about in a sec. But again, we think that's probably underutilised at the moment by investors who are income focused, and I'd much rather be putting my money, if I was a retiree, in something like that than buying bank shares or direct equities, which are going to have lower dividend yield or lower distribution yield and potentially more risk and lower down the capital stack. Like I said, this is a defensive version of that. This only invests in investment grade bonds. It's a much more conservative portfolio. It's there to generate, stable returns for investors, pay regular income, reliable income. The yield on this is closer to 7%. Again, it's had a pretty good last 12 months. We've made a decision to sort of increase duration or interest rate exposure in both these. Now, I know at the moment that's quite topical, but we think the trends and the data still points to an overall trend down in inflation. It might not be at the exact pace that everybody thinks at the moment, but we don't see material risk there at the moment with the data that's available, and that's been a good strategy for us so far. So that's the I suppose the defensive side, and you can see here you could be blending some equities and some defensive income to get a risk profile appropriate approach for almost any client. The final one, and my personal favourite of the multi-manager portfolios that we manage, is the Absolute Return SMA. This is a hedge fund strategy type approach where we pick 4 to 8, sort of hedge fund strategies, global macro, trend following quant strategies to give people, low correlation to equity and bond markets and still generate positive returns. This is really come into its own in the last couple of months after some modest underperformance. It's got a really hard benchmark of CPI +4, so this benchmark never goes down, which is tough on us, but we think it's reasonable, and we're really excited to see a few more inflows in that product. Because we do think it could add value, particularly for those younger investors who are looking for largely an equities type exposure, but they can't seem to. But they want some diversification benefits and some negative correlation, because at the moment, it's hard for younger people, I suppose, to think about investing in bonds, and I can understand why. All right, we'll just cover one manager from that, which is Winton. They're a systematic trend following strategy. They invest across 120 markets. They've got 12 billion in assets under management, 190 employees. They're headquartered in London. And I think this is really a great example of the value the investment committee can add in these multi-manager portfolios. We added this Winton product in May of 2022, which at that point had done a total cumulative return for the previous 5 years of only 16%, which was significantly below peer group and below managers. So if you were just looking at historical returns, you never would have picked this manager for this product. But since May 2022, this product has gone up 22.5% in those 2 years alone. And when I went back and reviewed our notes and the minutes from our investment committee meetings, we really identified, using Gavin Duckett's really expertise and extensive knowledge of sort of trend following and quant-based strategies, we're able to identify Winton as likely to outperform in the forward market, and that underperformance would come back and it would sort of overcorrect to the upside. So we've been able to benefit from that. These kind of products are fantastic. It's got a Sharpe ratio of 1.3, which, anyone who knows anything will tell you that's, world class. And with low correlation to markets, it's got a beta of, 0.13. So if you've got an ASX 200 ETF that tracks the index, that's got a beta of 1. So this, you can say the correlation here to markets and equities more broadly is near zero. It's had a fantastic last sort of 3 years. Particularly in the last 2 years, a lot of those returns have come. So, we're really excited to have that in the portfolio for clients and performing well. Almost at the end, guys. I'm just going to do a quick outlook, and I'll make this real quick, and we can just get into Q&A. So for go by asset class. For equities, we're seeing lots of opportunities. We think earnings are at or near cyclical lows, early phase of the recovery part of the business cycle, which is probably the best time to be investing money, the hardest for people to part with money, but the best. We think smalls are going to continue to outperform large. Doesn't mean there's not opportunities in large caps, but we think smalls are poised to benefit. And we're probably overweight emerging markets in a global equities context, and specifically Asia, where we see real value, I suppose, relative to history and average valuations. In the fixed income universe, we're investing in traditional bonds over hybrids and preference shares. We're in those fixed rate bonds with some duration relative to those floating rate bonds that don't have duration, or the hybrids, as I said. The yields look attractive. I know term deposits are running at 5%. But there's no capital upside there, and you can get better returns from bonds at the moment, and have some capital upside risk if the interest rates and inflation continue to trend down. From a macro perspective, we're pretty neutral on the currency, don't have any particular views there. And as I said, we're not going to get carried away with a single data point around inflation, but happy to change our mind if we think that the balance of probabilities does shift. From a thematic perspective, it's the same old stuff that we're always banging on about, the energy transition and the critical minerals associated with that, whether that's lithium, silver, or the stuff that gets ignored as a result, like coal. We continue to like picks and shovels type businesses, not necessarily specifically, mining services, though we do own, Monadelphous and Imdex and RPM, or RUL is the code for that, but more so just the providers to businesses that are growing, sectors where there's high growth. We like that idea. Continue to chase recurring revenue and businesses that can grow their revenues but not their costs, those operating leverage opportunities, and those declining bond yield beneficiaries where we think we've got a tailwind from valuations and a declining cap rate in some of the REITs and that kind of thing. So that's pretty much covers off everything. I can see there's a red dot on Q&A, and we're going there now. So Q&A, Benny, I'll let you take over. I think everyone's heard enough from me.
Yeah, so chuck your questions in the Q&A box, and we'll get to them shortly. We did have a few questions that were submitted at registration, so we'll just start with them. Okay, we've got, where to from here for the market? Is it very expensive currently? No, is the answer. It's not very expensive currently. But I mean, the real question is which market and what sub-segment. If your only basis for value is historical price, the market's always going to feel expensive. The market goes up a lot more and by larger quantums than what it goes down generally. If you want to look at kind of forecast PEs for the next 12 months, only really the US market is trading materially above 10-year median valuations. Most other equity markets are kind of in line or below or fractionally above.
And I'd argue again, as we've sort of said throughout the presentation, that earnings in a lot of places appear to be sort of at cyclical lows. So you've got to start thinking about the denominator on some of those PEs, and maybe pricing in a bit of upside there. So yeah, no, not particularly expensive in my view.
Just also to add to that, I think there's a lot of narrative about the US market particularly kind of keeps hitting all-time highs based off the Magnificent Seven and those tech companies. But, that doesn't mean there's opportunities elsewhere, as we touched on across the investment universe, and particularly in my investment universe where I kind of focus in Australian equities and particularly small companies. Like there's a lot of those small companies that haven't sort of rallied as hard as those larger companies. So, even if the market appears expensive, not necessarily all the way through the market. There's a question here: do you remain positive about the small caps fund position in Fiducian Group?
Yeah, we do. We think that's a pretty good business. We have sold a few shares in Fiducian just recently. Not for any other reason than valuation, and to fund a couple of other things that we're looking at that maybe are a bit more attractive at these prices. But I mean, Benny, you go through the metrics on it. It's pretty good. It's like it stacks up pretty well. I mean,
it's kind of in our wheelhouse, given that it's in the financial planning, funds management platform space, and it's a business that we like in the sense that it controls its own distribution. Whether it's Fiducian or there's another company we own, Australian Finance Group, AFG, same situation. If you can kind of control your distribution, it enables you to grow into higher margin products, which is what Fiducian's done through its funds management and platform businesses. I mean, it does have leverage to the market, of course, but earnings were up circa 20% at the last report, and it's only on about 15 times PE on a forward-looking basis. So when you combine that with the net cash balance sheet, it's still fairly attractively valued. But yeah, as Luke said, we did trim that position just to manage the size. Okay. About fees. So what fees do you charge for the SMAs and the small caps fund?
I better do this one. Okay, so if you're a Seneca client, you don't pay for any of the product. It's any of the SMA product, I should clarify. It's zero management fee. You're not paying, for a fund manager to run those products for you. If we pick managers in the underlying, multi-manager strategies, you'll pay those fund managers, whatever we choose. But I mean, the fees on those vary because the positions vary, and we take stuff in and put stuff out, or vice versa, all the time. If you want to be a client of mine, what we charge you will depend on what your advice needs are, your portfolio balance, but generally it's around that 1% per annum mark. That's charged monthly and debited from your investments. The only other fees you'll pay would be to our platform provider, which is Premium, for their custody and administration services. They range from, or they cap out at about $3,000 a year, but from 33 basis points to 10 roughly, so not too expensive and certainly competitive with everything else in the market. The small cap fund is kind of the exception. That's kind of on the outside, but again, that is a zero management fee product, as Ben touched on before. We only take performance fees there from wholesale clients, which is 20% of all performance above the RBA cash rate and the high watermark. So yeah, that's how we charge our clients, and charge for access to these products.
Okay. In terms of the cash levels in the portfolio, do you want to just touch across the different funds?
Oh, yeah. Sorry. Yeah. How much cash? Look, we don't hold cash. Is probably the best way to answer that. We only, if there is cash in one of the SMAs or even in the small cap fund, it's really just working capital, in the sense of, we might be waiting to fund a new idea, or we've just sold something and haven't quite got back to buying something else yet, or we're staging an entry or an exit out of something. So yeah, if you want to hold cash, we suggest you don't pay us to hold cash for you. You just hold the cash separate. And save yourself some fees, which we think is reasonable. You pay us to invest, not to hold cash. I'll just do this last one as well while I'm here.
Yep.
So distribution policy, For the small companies fund, again, that's a typical managed fund unit trust. We're going to do annual distributions, but we can do, more regular ones at our discretion in line with the mandate. But we're just for the first year, we're looking at just one annual distribution at the end of the year, and that'll be June 30. For the SMAs, you can set up any kind of combination of distributions that you like, whether that's you want a regular fixed dollar amount every month to sort of pay an income in a pension phase or any other phase of life, that for that matter, whether you want to just receive income as it's received, whether you want to reinvest and pro rata that income across the rest of your portfolio or into a specific product, or to build an exposure in a particular area, it's all no problem. It's super flexible platform, a super flexible sort of framework we've developed. So yeah, there's no limitations on that. But yeah, for the small cap fund, it's an annual distribution.
There's a couple of questions that have come through live now.
Yeah.
So,
that's fiducian again.
Fiducian, we've kind of touched on.
Lithium.
And our view on the lithium sector. I might leave that to the guru who's been calling this one since 2019.
Okay, so look, I could talk to you for another half an hour about lithium. We think that you've seen the bottom of the price, lithium price now. We think demand will correct. I've written about it a lot. I think I would just point you to the Livewire article I wrote, 6-8 months ago, which covered the lithium sector pretty well, and our sort of preferred ways to play it. But yeah, I would say just go read that because, and if you want to come back to me after that, then that's fine. If you've got any more questions, I'm happy to answer them. All right, I think we're done.
No further questions here by the looks of it.
Don't think so.
Anything further, shoot us an email or give us a call. Happy to follow up with anybody. Yeah,
and if you've got any more questions about product or you want to catch up with me and have a conversation about your specific circumstances or getting some advice or some financial planning or whatever it is that you might need, please feel free to drop me an email or just call the office anytime. But look, really stoked that 40 of you got it. Yeah, 40 odd got in there today and listened to us. Hope it wasn't too boring, and look forward to seeing you next quarter.
Cheers.